Imagine it's a Tuesday afternoon. You open your banking app and see a number. Let's say it's $5,000. You feel a sense of ownership and security, believing that money is sitting in a digital vault, tethered to your name, waiting for you to spend it. However, you were wrong. The moment you hit deposit, that money stopped being yours. Legally speaking, you didn't put money into a safe. You gave a private corporation an unsecured loan. You are now a creditor, and in the eyes of the modern financial system, that $5,000 balance isn't cash. It is a promise that the bank hopes it never has to keep all at once. Welcome to the great disappearing act of modern finance. We spend our lives chasing a currency that, for the most part, doesn't actually exist. We operate on the assumption that the banking system is a warehouse, but in reality, it's an elaborate game of musical chairs where the music never stops and there are only 3 chairs for every 100 players. This matters not because of some looming doomsday or fringe conspiracy, but because the very definition of money has shifted under our feet. If you don't understand who actually controls your balance, you're playing a game where you don't even know the house rules. To understand why your balance is an illusion, we have to look at how a bank actually functions. In a rational world, if you gave someone $10 to hold, they would put it in their pocket until you asked it back. But banks don't have pockets, they have spreadsheets. When you deposit money, the bank immediately splits it. A tiny fraction stays in reserve, often as little as 0% in certain jurisdictions today, while the rest is bundled into mortgages, lent to car dealerships, or used to fuel complex derivative trades. This is fractional reserve banking. While it sounds like a dry textbook term, it is actually a form of legal alchemy. Think about it this way. You deposit $1,000. The bank keeps $100 and lends out $900 to Bob. Bob buys a laptop, and the seller deposits that $900 into their bank. That bank keeps $90 and lends out $810. On paper, the system now says there is $2,710 in total deposits, but there is still only that original $1,000 in physical existence. The system creates money by creating debt. Your bank balance isn't a reflection of wealth stored, it is a reflection of how much the system owes you. The irony is that the system only works as long as we all agree to pretend it's real. It is a collective hallucination. If everyone decided they wanted their physical cash at the same time, the doors would lock, screens would go dark, and the money would evaporate because it was never there to begin with. We saw a glimpse of this in 2023 with Silicon Valley Bank. It wasn't a slow rot, it was a digital sprint. In the age of iPhones, a bank run looks like a few taps on a screen. $42 billion vanished in 24 hours because depositors realized the promise was worth more than the actual cash on hand. There's a deeper layer to this regarding control. If you have a $20 bill in your physical wallet, you have total sovereignty over it. You can transact freely without anyone tracking or canceling the bill. However, the moment money enters the digital banking layer, it gains invisible shackles and becomes programmable. We are moving toward a world where access to your own labor is contingent on the approval of intermediaries. We see this in the rise of de-banking and asset freezing for those with unfavorable risk profiles. You could have $1 million on the screen, but if the withdraw button is disabled, you have $0 in reality. We have traded sovereignty for convenience, moving from a system of proof of ownership to a system of permission to spend. Beyond control, there is the math of inflation, the silent confiscation of your balance. If your savings earn 0.01% interest, while the cost of goods rises by 5%, the bank is effectively using your capital to make high-interest loans while handing you back a currency that buys less than when you earned it. Furthermore, if the system enters a crisis, you are at the bottom of the repayment hierarchy. In many jurisdictions, bail-in laws allow banks to legally convert your deposits into equity to save the failing institution. You don't get your money back, you get shares in a bankrupt entity. This escalation points towards Central Bank Digital Currencies, CBDCs. This next phase removes the middleman, linking your wallet directly to the central government. In this scenario, money could have an expiration date, be restricted geographically, or be turned off based on social credit scores. Money transforms from a tool for the individual into a tool for the architect. We like to think of ourselves as masters of our finances, optimizing taxes and hunting for interest rates, but we're all building houses on land we don't own, operating within a framework where the definition of value can be changed behind closed doors. The system isn't broken, it is functioning exactly as designed, to keep capital moving, debt growing, and the depositor in a state of dependence. So look at your bank balance one more time. That number isn't a measurement of what you have, it's a measurement of what you are owed by a system that is over-leveraged, highly interconnected, and legally protected from its own mistakes. The question isn't whether you have enough money in the bank. The question is, if the music stopped today, how much of that money would actually belong to you?